Welcome back to the Uncovered Economy. Oil just made a move that most investors will ignore until it is too late. This was not a small bounce or a random spike. Oil broke out at the same time geopolitical tensions intensified. And when oil breaks out during rising global instability, history says something bigger usually follows. This is the kind of signal that shifts entire market cycles. If you care about protecting your purchasing power, you need to understand what just happened. Because oil rarely moves alone. It tends to move first, and when it does, other assets respond. Before we go any further, if you want clear macro breakdowns focused on what actually moves U.S. markets, hit subscribe right now. Timing matters in cycles like this. The difference between reacting and anticipating often determines profit or loss. What we are seeing today could shape the next major move in silver, and most people won't recognize it until momentum is already underway. Markets do not wait for official confirmation of war. They price probability. The moment headlines shift from routine diplomacy to escalation risk, traders adjust exposure. Oil is always the first place capital flows during Middle East instability. That is not emotion. That is supply risk modeling. Roughly 20% of global oil supply moves through regions sensitive to conflict. Even the possibility of disruption is enough to push futures higher. Energy traders do not need certainty. They price risk in advance. Now think about what higher oil really means for Americans. It means higher fuel costs at the pump. It means higher transportation expenses. It means higher food and manufacturing costs. Energy touches nearly every part of the U.S. economy. When oil climbs, inflation expectations begin climbing with it. And inflation expectations change everything. If inflation begins rising again, the Federal Reserve faces another difficult choice. Raise rates and risk slowing growth further, or hold steady and risk inflation accelerating. Neither path is comfortable. Both paths create uncertainty. And uncertainty fuels demand for hard assets. Silver sits right in the middle of that equation. Silver does not just react to fear. It reacts to shifts in monetary conditions. If inflation rises faster than interest rates, real yields fall. When real yields fall, precious metals tend to perform well. This pattern has repeated for decades. Oil moves first. Inflation expectations follow. Real yields shift. Silver responds. Right now, oil has made the first move. Silver has not fully broken out yet. But it is positioned just beneath important resistance levels. That positioning matters, because when oil sustains momentum, pressure builds underneath silver. And once pressure releases, moves can be fast. We are not predicting war. We are analyzing probability. Markets move on risk perception, not confirmed outcomes. If oil remains elevated, investors will begin hedging more aggressively. Hedging behavior includes precious metals. Institutional investors do not wait for retail traders. They move early, and they move quietly. The U.S. economy today is more leveraged than in previous oil spike cycles. Federal debt has surpassed $36 trillion. Interest payments are climbing rapidly. Consumers are already dealing with elevated prices. Oil rising into that environment increases fragility. Fragile systems react more violently to stress. Silver thrives in fragile systems. This is why oil's breakout matters beyond energy. It may not be about gasoline alone. It may be the first domino in a broader inflation repricing cycle. And silver tends to accelerate when that cycle begins. The question is not whether silver can move. The question is whether oil's breakout has staying power, because if it does, silver may not remain quiet for long. Oil moving higher is not just a headline event. It is a monetary event. When energy prices rise sharply, inflation expectations rarely stay still. Bond traders begin adjusting models almost immediately. They do not wait for next month's CPI report. They watch oil, shipping rates, and commodity flows to estimate what inflation will look like. The forward pricing is what moves markets. If oil remains elevated, inflation expectations increase. If inflation expectations increase faster than nominal rates, real yields decline. Real yields are one of the most powerful drivers of precious metals. When real yields fall, holding non-yielding assets like silver becomes more attractive. This dynamic has repeated for decades. It is not theory. It is structure. Silver reacts differently than gold. Gold tends to move first during fear events. It absorbs immediate capital from defensive flows. Silver, however, tends to accelerate once momentum builds. Because the silver market is smaller, buying pressure moves price faster. That is why silver rallies often feel explosive. It takes less capital to create larger percentage moves. Historically, oil spikes have preceded silver surges. In the 1970s, energy shocks fueled inflation and metals exploded higher. In 2011, commodity strength pushed silver toward historic highs. In 2020, volatility initially hit metals before massive upside followed. Each time energy instability played a role. Oil tends to be the early signal. Silver tends to be the acceleration phase. There is another factor most investors overlook. Silver is not just a monetary hedge. It is also an industrial metal. It is used in solar panels, electronics, and advanced manufacturing. If governments respond to instability with fiscal spending, industrial demand may remain strong. That dual role gives silver structural support. It benefits from both inflation, fear, and stimulus response. The gold to silver ratio is worth watching. When uncertainty rises, gold usually leads. But when inflation expectations strengthen, silver begins catching up. That ratio compresses during strong cycles. Compression often signals silver outperformance. If oil sustains momentum, compression becomes more likely. And compression means silver gains speed. Now consider the broader U.S. environment. Federal debt is already high. Interest payments are consuming a growing portion of federal revenue. Consumers are stretched by elevated costs. Regional banks have shown fragility in recent quarters. Commercial real estate remains under pressure. Oil rising into that backdrop increases systemic stress. When systemic stress rises, investors seek protection. Protection does not mean panic. It means allocation shifts. Large funds adjust exposure gradually. They increase commodity weighting. They reduce cyclical risk. They position before volatility expands. Silver is often a beneficiary of that positioning. It does not need immediate headlines to rally. It needs structural alignment. Right now, alignment is forming. Oil has broken resistance. Inflation risk is re-entering the conversation. Real yields are vulnerable to decline. That combination is powerful. It does not guarantee a straight line up. Silver rarely moves smoothly. It surges, retraces, and builds again. But when oil remains elevated, downside pressure on metals tends to weaken. The floor becomes stronger. Momentum builds underneath resistance. If oil continues climbing for several weeks, inflation narratives will intensify, media coverage will amplify concern, political pressure will increase, the Federal Reserve will face sharper scrutiny. Markets will begin pricing policy uncertainty more aggressively. Policy uncertainty fuels metals. Silver thrives in policy uncertainty. The key variable is duration. Short spikes create short reactions. Sustained breakouts create sustained repricing. Oil has moved first. Silver is watching carefully. If oil holds its breakout, the probability of a silver breakout rises dramatically. And when silver breaks, the move rarely goes unnoticed. From here, markets face three realistic paths. Each path carries different implications for oil, inflation, and silver. Understanding these paths helps remove emotion from decision-making. This is not about predicting conflict. It is about evaluating probability. Markets operate on probability, and probability shifts with events. The first scenario is de-escalation. Diplomatic channels cool tensions. Oil retraces part of its breakout. Inflation expectations stabilize. Volatility declines gradually. In this case, silver likely consolidates rather than surges. The risk premium fades over time. Under de-escalation, the Federal Reserve regains breathing room. Rate expectations settle. Real yields stabilize. Precious metals drift sideways. Silver may test resistance, but fail to break decisively. This scenario represents a short-term shock that fades. Markets return to focusing on domestic economic data. The second scenario is prolonged tension without direct escalation. Oil remains elevated for weeks or months. Inflation expectations stay firm. Bond markets remain sensitive. Investors slowly increase defensive positioning. This environment tends to support metals steadily. Silver grinds higher rather than exploding overnight. Prolonged uncertainty creates structural hedging. Funds adjust exposure gradually. Commodity allocations increase. Precious metals become portfolio insurance. Momentum builds beneath resistance levels. Once resistance breaks, acceleration often follows. This is historically a powerful setup for silver. The third scenario is rapid escalation and broader financial shock. In sudden shocks, liquidity becomes the priority. Investors sell risk assets aggressively. Sometimes they sell metals temporarily to raise cash. We saw this during 2008. We saw it again in early 2020. Liquidity squeezes can distort short-term price action. However, liquidity events rarely suppress metals for long. Once central banks intervene, hard assets often rebound sharply. If escalation triggers aggressive monetary responses, inflation risk increases. Inflation risk supports metals strongly. Silver can move violently during such transitions. Short-term volatility may be extreme. Long-term direction often favors hard assets. Now consider the current U.S. backdrop carefully. Debt is historically high. Interest expenses are growing rapidly. Fiscal deficits remain persistent. Consumers are still recovering from prior inflation waves. Oil rising into this environment adds strain. Strained systems amplify external shocks. If oil stays elevated, inflation data may surprise higher again. That forces the Federal Reserve into another dilemma. Tighten policy and risk recession, ease policy and risk inflation acceleration. Both options create uncertainty. Uncertainty drives defensive positioning. Defensive positioning benefits silver. Markets are forward-looking. They price expectations before confirmation. If traders believe oil will stay high, they adjust allocations early. Waiting for confirmation is often costly. By the time headlines confirm inflation pressure, metals may already have moved. That is why oil's breakout matters now. It is an early indicator. There's also a currency dimension. If inflation rises while rates hesitate, the dollar can weaken. A weaker dollar supports precious metals globally. If risk aversion strengthens the dollar temporarily, real yields may still decline. Declining real yields also support metals. Silver has multiple pathways higher in uncertain environments. It does not rely on a single outcome. The longer oil remains elevated, the stronger the alignment becomes. Alignment between inflation risk, policy uncertainty, and fiscal fragility is powerful. Silver thrives when multiple stress factors converge. Right now, those factors are converging. Oil has already moved. Inflation risk is reemerging. The next response may not be subtle. This is why watching oil closely is critical. It may not be the final story. It may be the opening chapter. And silver often writes the second chapter in bold print. The key question remains duration. If oil sustains strength, silver's breakout probability rises sharply. Markets are preparing for that possibility. Now let's bring this back to you. This is not about panic, it is about preparation. Oil has already made its move, silver is positioned to respond, and the window between signal and reaction is often short. Understanding that timing matters. Most investors react emotionally. They wait for headlines to confirm what markets already priced. By the time confirmation arrives, momentum is usually well underway. Smart positioning happens before consensus forms. That does not mean reckless action. It means informed awareness. Oil's breakout is an information signal. Silver remains just below key resistance levels. If oil sustains its breakout, pressure builds underneath silver. Pressure eventually seeks release. When resistance breaks, momentum traders enter quickly. That often creates sharp upward moves. Silver does not climb quietly when momentum begins. It tends to accelerate. You have to ask yourself a simple question. If oil stays elevated for several weeks, what happens to inflation expectations? If inflation expectations rise, what happens to real yields? If real yields fall, what happens to silver? The chain reaction is logical. Markets follow incentives, not emotions, and incentives are shifting. The United States economy is already carrying heavy debt. Interest payments continue to rise. Consumers are cautious. Small businesses are sensitive to cost increases. Oil pushing higher adds pressure to all of it. Pressure changes behavior. Behavior changes capital flows. Silver benefits from capital flow shifts. It benefits when investors seek alternatives to traditional financial assets. It benefits when policy uncertainty increases. It benefits when inflation confidence weakens. Right now, all three forces are present, not confirmed, but forming. This does not guarantee a straight line rally. Silver is volatile by nature. It can surge and retrace quickly. It can shake out weak hands before continuing higher. That volatility is normal. What matters is the structural alignment. And alignment is strengthening. Oil moved first. Inflation expectations are adjusting. Policy uncertainty is rising. Silver is watching. If oil continues higher, silver's probability of breakout increases sharply. That breakout could happen faster than most anticipate. Momentum rarely announces itself politely. Now I want to hear from you. Do you believe this oil breakout is temporary noise? Or do you believe we are entering another inflation-driven cycle? Your perspective matters. Drop your thoughts in the comments below. I read every single one. Real discussion sharpens understanding. If this breakdown helped you connect macro signals before they hit mainstream headlines, share this video with someone who follows gold, silver, or energy markets. Most people wait for confirmation. Markets move before confirmation. Being early is uncomfortable. Being late is expensive. Oil has already made its statement. Silver may be preparing its response. This is why the uncovered economy exists. We focus on signals before they become obvious narratives. We analyze probability before panic sets in. We connect oil, inflation, policy, and metals into one clear picture. Because macro cycles do not happen randomly. They build layer by layer, and right now a new layer may be forming. Stay disciplined, stay analytical. Stay aware of what oil is telling you, because sometimes the first move is the most important one. Silver could be next, and when it moves, it may not move quietly. I'll see you in the next one.